Hi, I'm Max Walker&Williams, and today we're going to be talking about the money supply myth. So basically, when you know something, you have knowledge of something, you sometimes take that for granted, and I absolutely did that with what I'm going to be talking about today. So I met a friend, I was with a friend of mine yesterday, who I respect absolutely. She's a fantastic business person, really sophisticated and smart. She knows what she's doing, she knows what she's talking about. I'd been with the stockbrokers that I used yesterday, and which you'll know if you follow me on Instagram. I went and saw the stockbrokers, and she knew I'd been there, so we were having a catch up. And she was saying, you know, what are they saying about the market? What do they think about the future of the markets and so on? Is the economy okay? And so on and so forth. Now, I truly believe that there is a crash or a correction or a depression or a recession coming, and I'll explain the difference in a second. So I just want to make sure that we have insurance against a correction or anything else in the market to make sure that we're solid moving forward. So she was saying, what do they think? And by the way, they think it's going to be about a year before we see a correction because of all the money that's still sloshing around. And she said, well, we don't have to worry too much because, you know, the money has to go somewhere. And you're a good person, I'm a good person, we have good businesses, so we're always going to be okay, because there's always going to be money, and the same amount of money always is going to be around, and the money's got to go somewhere. And I've heard that before. I've heard people say a few times, the money has to go somewhere. And it got me thinking, I realized that my friend, who I respect and really is a fantastic businesswoman, doesn't really understand how money supply works. So it got me thinking that I thought that was a given, that everyone knew that, but if she didn't, then certainly there may be other people who don't either. So I decided to make this video today for my friend and for everybody else at home that's interested in learning about how money works. Okay, so what is the money supply myth? So the money supply myth is that there's a kind of amount of money in a country, America, Britain, wherever, Germany, and also there's the same amount of money all around the world, and it never really changes. You know, it sort of never fluctuates. There's always about the same sort of amount of money, and that just isn't true. It's a complete myth. So, what are we talking about? Correction, recession, depression. So a correction is when the market dips a bit, but then comes back up. So that's a correction. So a price has been corrected, or it drops a bit and then sort of plateaus and stays where it was. So things got a little bit too expensive, and then they drop back a bit, and then they carry on at what is the correct price, the correct value of something. And that can happen in crypto, it can happen in property, it can happen in tulips, it can happen in gold, it can happen in anything. It can happen in the price of wood or screws. So that's a correction. A recession is where things shrink. So the GDP, the gross domestic product, that's how much a country puts out, reduces month on month. And then a depression. And the famous one is obviously the Great Depression, which started in 1929 and lasted through to 1933. And that is where you see the pictures of people jobless, hordes and loads of men looking for jobs, and only one job and hundreds of applicants. And that's, really life-changing, awful situation where there is no money, no jobs, no opportunities. Now, there are actually two parts. When one of these things happens, particularly with the depression, there are two things that happen that mean that the money supply in an area, a city, a country, and in the world shrinks. It actually shrinks, or can go up sometimes as well. So the amount of money in circulation can increase or decrease, depending on what the governments are doing. But today we're talking about decreasing money supply. So there are two things to consider when you're considering money supply, and that's velocity and circulating supply. So I'll come over to circulating supply in a minute, but let's start with velocity. So it isn't just the amount of money that is in society, but it's also the velocity of that money that matters. So what is velocity? So velocity is basically how much a £10 note or a $10 bill or a €10 note is spent. So you've got somebody at home here. I don't know why their house is green or why they've got a garage door for a front door. I don't know, maybe I started with a shop and ended up with a house. But so forgive my drawings. But you've got somebody at home here. He's a barman and he has £10 or $10, whatever. And he spends the $10 or pounds in the fishing shop. So that £10 has bought £10 or $10 worth of goods. Okay, and then the person who works or owns the fishing shop spends $10 and she spends it at the nail salon. So she goes to the nail salon with the $10 and she spends it on nails. So it's now that physical note has bought $20 worth of stuff. So the economy has moved by $20, has churned over by $20. Then the lady who owns the nail bar, she spends £10 or $10 at the bar. And guess who works at the bar? The barman. So the $10 it goes to the bar and drinks are consumed. So now that note has now been used 3 times, and that's $30 or pounds worth of stuff, of transaction, of value, of movement, of turnover. And that's the economy moving, okay? So that's velocity, and it's very important because you could give everybody in the UK £1 million, but if nobody spent 1 penny, it would make absolutely no difference whatsoever to the economy, of course. Because if everybody took the £1 million in cash and put it under their bed, then it would have absolutely no effect, positive or negative, to the economy because it isn't in the economy. It would have a velocity of 0. Equally, if you had £1 million and you gave 1 million people £1 and they all spent it like crazy on a sweet and then on a chocolate bar, on whatever, a pound, then that £1 million changes hands constantly. It could have a velocity of 10 million. So that's velocity, okay? And then the bar, guess who works at the bar? The barman. He is paid the £10 for his time and his work. So and then he's at home and around it goes. And that's velocity of money. Generally, during a correction, a recession, or a depression, the velocity of money slows right down. And the reason that happens is because people are nervous about the next money coming in. So if you have a job and you're nervous that you're going to lose your job, you obviously spend less money. You hold on to your money and the velocity slows down. But if everybody does that across the country because they're nervous, then the velocity of the entire country can slow down. And actually, this chap did spend it in the fishing shop, but the fishing shop owner was nervous about customers coming tomorrow. Maybe they don't come because they've lost their jobs. So doesn't get her nails done and she pockets the money instead to pay her mortgage on a rainy day. If people are nervous, the velocity of money slows down and that makes the economy shrink even though the same amount of money is in society. And if people are nervous about it, it doesn't matter how much money you throw with quantitative easing. If people aren't willing to spend the money, they just get the free money and they put it in their pocket and they save it for a rainy day and it does nothing to help the economy. So that's velocity. So that's the first thing you have to consider when you're considering monetary supply. So it's velocity. And then the second thing is circulating supply itself. So how much money is actually in the economy? I was going to say physical, but as we'll get to it in a minute, most money these days isn't physical. So to give you some idea, we have to look back at the last time the economy shrank and velocity slowed. And that, of course, was in the end of 07, early 08 market crash, and it was a global phenomena. In 2000, if you compare the year 2000 to the year 2007-8 and going into tax year 2008, USD, United States dollars, circulating supply dropped by 16%. So 16% of the money that was in America, in supply, in the economy, sloshing around, making things move in 2000 was 16% smaller when the market crashed. Only 10.2% of United States dollars today, USD, the dollar, is physical money. So the other 90%? No, just under 90%, 99.8% of money of American dollars is digital. So easy peasy to take out of the economy, you just start deleting numbers on a screen. It's not even physical where the mint has to wait for people to deposit cash into a bank and then the bank bring that in and then they destroy the money and they don't resupply it. They don't have to do that. It's much, much simpler. They can literally just start deleting zeros on balance sheets on computers. And I'll get to explaining that in a second. Now, so first of all, we have to understand, so now we understand the basics of velocity, and that's fear and confidence in the market. If you believe things are buzzing and you might even get a pay rise next month, you might spend more money this month than you were going to because you think, oh, my job's safe, and you might even think about it. It could be a subconscious thing. You think, if times are good, my wife's just had a promotion. Let's go to the cinema tonight. Let's go to for a meal or whatever. Let's take the kids on holiday. Let's buy a speedboat, whatever. So we now know about velocity and we also know about circulating supply, but we have to understand how money is created. So up until quite recently in the UK and the US predominantly, fractional reserve banking is how money was created. So a lot of people believe, less people than the monetary supply myth, but a lot of people still believe the old school of banking, which is that old people and retired people and young retired people, old retired people, put their savings in a bank account and they are paid a certain amount of interest for their savings. The bank then takes that money that's been given to them by the savers and it lends it to young people buying mortgages, business people starting out, business people borrowing money to buy more product, more supply, to create more stuff to sell, and everyone in between that wants to borrow money. And they charge the people that borrow the money more than the people that they take the money off. And the difference between what they pay the savers and what they charge the borrowers is their profit. Now that hasn't been the case for a long, long time. And when you think about it, it's pretty clear why that would be. It's because there are a lot less people saving a lot less money than there are people trying to borrow a lot more money. So what do I mean? To give you an example, the average net wealth of somebody here in the UK between the ages of 16 and about 42 is about £7,000, £7,500, somewhere there or thereabouts. And I don't know, but I'm guessing America's probably the same. Now, if those people are looking to save, it takes a lot of £7,500, even if their whole net worth is in cash. It takes a lot of those people's savings for one mortgage of $150,000 or pounds. So you can see that quite quickly you run out of people who can lend the money. So where does the money come from? Well, it used to be fractional reserve lending. And you might see this particularly in Occupy Wall Street. If you look back at some of the footage, and you'll see them holding up pickets that say ban fractional reserve lending. And the reason they don't like that, and they're right in some sense, is that fractional reserve lending, if abused, can be very, very dangerous. Now, the reason it can be dangerous is pretty obvious. If you owe out a lot more, like 10 times more or 20 times more than you have in assets, it's seriously a problem if the people that you owe money to all come to get their money back at the same time. You owe out far more than you've actually got in reserve. So you're underwater or upside down, as they say in the banking industry. So that's how it used to work, and believe it or not, it's actually got worse if you're not a big fan of fractional reserve lending. In the UK and the USA, they've done away with fractional reserve lending. So the multicolored Mohawks got what they wanted, but they didn't. They got the reverse of what they wanted. It's now unlimited. It's not that we've gone back to the old school way of banking. You lend me £10, I pay you £1 a week. I lend £10 to Bob, and Bob pays me £2 a week, and then that pound I keep, and everybody's happy. Bob's making money. He's making more than £2 a week with his £10. Betty's getting more. She's getting £1 a week on her £10, and I'm making £1 a week on her £10 for facilitating the deal. That doesn't happen anymore. Fractional reserve lending. Betty gives me £1. I can then lend out £10. That no longer is the case. Now is the case. If the bank has the appetite to lend, then lend they can. Generally speaking, with most of the high street major banks, of course there's exceptions, but generally speaking, if the bank wants to lend, they can literally just borrow the money and lend it off the IMF, which is the International Monetary Fund, or the Bank of England here in the UK. Okay, so now we understand that we've got all of this money and how it is created. Now we need to understand, how does money leave the system? Okay, so there are a few different ways money leaves the system. The first one is bad debt going bust. So if you buy a property for $200,000, and just for the simplicity of it, you have a 100% mortgage, you owe $200,000 on the house that's worth $200,000. If there's a recession, a correction, or a depression, and all of a sudden the house is only worth $150,000, and at the same time you lose your job and you can't make the mortgage payments, the bank want to get their money back, so they repossess the house off the person, they put it in an auction or they put it on the market for sale, and because the price of property has dropped, and there's a lot of properties coming on the market making it worse, compounding the problem, that drop further, it's worth $150,000, it sells at auction because it's an auction for $140,000, there's a $60,000 loss on the house that the bank has on their balance sheet. It comes back to Bob and says, Bob, we've sold the house, you now owe $140,000 less than you did before, but the bad news is you still owe us $60,000 that we lent you, that you bought with the house. Bob says, sorry, can't pay you, lost my job, not interested, can't help, and Bob declares bankruptcy. That money is then forgiven. It's forgotten, it's written off. And it literally has just, the £60,000 that Bob owed is now dead. It's now left. It's bad debt on their balance sheet, and eventually is wiped off the balance sheet altogether and is literally just deleted. Paying down debt. So other people who are further on in life and maybe don't have as much debt might have an unencumbered property, which means they don't have a mortgage, they don't owe any money on it, and they've got some savings, but they've got some credit card debts, they've got some store cards or credit cards or whatever, and they're nervous, or they're a young couple and they've got some loans, but they've still got their jobs, they haven't lost their jobs, and they're nervous about their jobs in the future, or they're nervous about the economy. Then they use their earnings, and rather than spending it on a holiday or in the restaurant with the velocity, if you remember, they actually do the opposite. And rather than holding on to it or putting it back in the market to keep the velocity going, they actually pay down debt. So they pay off the store cards, they pay off the credit cards, and in paying that money off, that credit card is then closed, that money is gone, it's out the system. So if you've got $20,000 credit card, and you use your wages, you get paid money in wages, and you send the money to the bank and repay the credit card and then close the account, that money, it literally comes off their balance sheet and disappears. That money is gone. The other way is banks refusing to lend. So obviously this isn't really money leaving the system, but it's also money not coming into the system. So if you go to the bank and say, look, I've lost my job and I need to borrow some money because I'm going to start a business, or because I need to just cover myself for 6 months while I go and find new employment, and the banks refuse to lend, it compounds the problem. Bob's not able to pay his mortgage, which is how we got into the mess in the first place, and new money is not created. So the young couple again, and let's pretend now they didn't pay off their credit card. In fact, they'd never had a credit card and they're going to apply for one. They're nervous again, or one of them's lost their jobs, so they think, right, well, we're just going to buy food and carry this over on the credit card. So they apply to the bank, who in good times would have said, yeah, absolutely, we'll give you a credit card. Now the bank is nervous because of what's going on, the correction, recession or depression, and the bank don't give them credit, don't give them the credit card. The money is never created in the first place. So it's not money leaving the system, but it's new money not coming into the system either. And then lastly, IMF. So even if sometimes the bank want to lend, the IMF, the Bank of England, that's the International Monetary Fund again, or the Bank of England, or somebody higher up the chain is refusing to lend to people lower down the chain. So the banks actually haven't been given the money to lend, even if they do have the appetite sometimes. So all of these things are happening at the same time. So you have people with money who are nervous and not spending it. Maybe the government's QE, quantitative easing, which is another posh way of saying printing money, literally just printing money and pumping capital into the banks in the hope that they will lend. The banks are nervous, so they don't lend, or they gamble on the stock market, or they do lend and then people borrow the money and just sit on it to have a nest egg, have some savings in case they lose their job, and they're worried. They apply early because they're worried that the company will turn them down for a loan later. I mean, if you think you're going to lose your job and you're going to need some money to cover you, the best time to apply for the loan is while you've still got the job. And then when you lose the job, you've got the loan. So, but then you wouldn't spend it. You wouldn't spend it in the fishing shop, the nail bar, or the bar. You would hold on to that money, and then if you don't lose your job, cool. And if you do lose your job, at least you've got that savings, you've got that nest egg. So velocity is slowing down. New money's not coming into the market because it's literally a credit crunch. If you remember 2007, 2008, it was called the credit crunch. And that's what they meant when the credit's shrinking. Banks higher up, big banks, world banks are refusing to lend to smaller banks. Even if they could borrow, they're not willing to lend to people in the society anyway. The people who have got the money aren't spending it, so the velocity slows right down and the whole economy contracts. And there's my friend saying, the money has to go somewhere. The money supply is constantly changing. It's really important you understand that, why that happens, how that happens, and what you should be doing if you think that this market is going to play out as it might. Deflation equals cash is king. So what we're really talking about here is deflation. So inflation is where things are getting more and more and more expensive, wages are rising, and the cost of beans or milk or whatever it may be, property or wood or screws or whatever, gold, Bitcoin, is increasing. That's inflationary. It's money becoming less and less because there's more and more of it being pumped into the system because times are good. So people are getting approved for loans they might not necessarily get normally. So that's more money coming into the system. Joe, who could never get a credit card all his life, he gets his credit card through the post. He goes and spends it. Boom, £20,000, bang, straight into the economy, injected straight into the blood of the economy. People aren't paying down debt because they think, why do I need to? It's fine. I can look at it later. No one's going, not no one, there's always people going bust. Fewer and fewer people in good times are going bust. So that money's not leaving the system. People are honoring their debts, they're paying because Bob's got his job and he's paying his mortgage and he's borrowed 100% of the value of the house and so on and so forth. So you've got all this money coming into the system and then the opposite happens when it starts to crash. That is deflationary. It's deflationary when money is leaving the system. What does that mean? It means there's less money about, so more money buys more stuff. Because if there's less people going to the fishing shop have a sale to try and sell more and encourage people who have got money to come in and spend it. Same with the nails, same with the bars. And if that happens across the whole economy, all of a sudden, where before you rung up to order something and they say, sorry, we're out of stock for 6 months, all of a sudden, not only have they got it in stock for you, but it's actually a half price. So one way of looking at it is the product is now worth less, or the other way of looking at it is my money buys more. So the money is worth more because there's less money in the system, therefore less people have money, therefore there's less money being spent. In a deflationary situation, cash is king. Now, a lot of people will say, oh, I'm okay, I've got gold, gold, and they're called gold bugs. And gold is a good investment for certain purposes, but it's a vehicle like any other investment. It's a vehicle, and you need to know how and when gold is a good investment. But to give you an example, on Monday, the 14th of March, 2008, 1 ounce of gold was worth $973. So 14th of March, 1 ounce of gold, $973. Things are getting worse and worse and worse as the year goes on. We're now from March to the Monday, the 27th of October, 1 ounce of gold is only $720. So the price of gold has absolutely plummeted along with the price of everything else. The price of property, fallen off a cliff. The price of food, because nobody's going out and fancy restaurants, off a cliff. Stocks, shares, all that, bonds, all off a cliff. And gold went straight down with it. The only thing that went up was the value of cash. Raw, hard, cold cash. Cash was king again. And by the way, if you don't believe that things were getting worse and worse that year, it was in Goldman Sachs announced that they were going bust around September time. So March, things were better. They were bad, but they were better than they were in October. And only a month later, Goldman Sachs, one of the biggest investment banks in the world, announced that they're going bust. So I hope it's a short video. I don't really want to, I like to do videos that I hope everyone gets and it helps everyone understand. I don't want to get too bogged down in technicalities. I've tried to sort of top line it for you. I hope this has made sense and been useful for you and given you a basic understanding of how money supply works and how lending and banking work a little bit. As always, thanks ever so much for watching. I'll see you soon.